In the mid-20th century, there was a silent agreement. If you worked hard and followed the rules, the economy would provide. Today, we are going to look at why that promise failed the millennial generation and how the system changed. Imagine it is 2008. A young graduate sits in a cramped, clay-molded apartment. The morning light filters through a small window as they refresh their inbox, only to find a life-altering email: budget cuts. The position has been eliminated before it even started. Outside, the sky turns a stark, moody red. Across the clay landscape, foreclosure signs begin to pop up like falling dominoes. This was the breaking point, where the traditional script for a successful adulthood was literally torn to shreds before their eyes. Millennials, born between the early 80s and mid-90s, entered a world that looked familiar but functioned differently. Often, they are blamed for their own financial struggles, with critics pointing to expensive lattes or vacations as the primary source of their problems. But is it really about personal choices, or is there something deeper? We need to look at the financial architecture, the very machine shifting beneath our feet. This isn't just a story of bad luck, it is a story of a changing economic engine. Let's go back to the post-war era. Picture a giant clay escalator carrying workers upward. As manufacturing expanded, wages moved in lockstep with productivity. If the factory produced more, the workers earned more. It was a shared rise in prosperity. During this time, human capital was a simple concept. You planted seeds of education and training, and they grew into sturdy clay trees that produced a steady harvest of income. It was a reliable cycle of growth and reinvestment in the workforce. But in the late 1970s, the tracks split. Imagine two clay trains, one named productivity and one named wages. They traveled together for decades, but then productivity accelerated toward the horizon, while the wage train slowed to a crawl, creating a massive gap. Now, consider the paradox of education. On a clay whiteboard, we see three boxes: the student, the university, and the lender. To keep up with a changing world, students were told they needed more degrees, but the pathway to freedom became a financial constraint. Global shifts made the situation even more complex. Clay icons of factories moved across oceans, while clay robots began to automate tasks. The demand for specialized credentials skyrocketed, forcing young people to take on mountains of debt just to qualify for entry-level roles. September 15th, 2008 became a generational dividing line. This was the scarring effect. Older generations often had buffers like home equity or savings, but for the younger adults starting out, there was no safety net, only a plummeting market. Think of it as a marathon. Two clay runners are at the starting line. The older runner starts the race immediately, but the millennial runner is held back for 10 minutes while the clock keeps ticking. No matter how fast they run, catching up feels impossible. The cumulative effects are staggering. Clay stacks of debt continue to grow, unpaused by the passage of time, while earnings and life milestones are delayed. The ladder to the middle class hasn't just lost its rungs, it has been moved entirely. This is the new normal. The escalator from the beginning has returned, but the incline is much steeper now. People are running faster than ever just to stay in the same position. It is a structural challenge that goes far beyond personal grit. Understanding this context is the first step toward change. By recognizing that these struggles are systemic rather than personal, we can begin to imagine a different architecture for the future. Thank you for joining us on this journey through economic history. As the sun sets on our story, the graduate from the beginning looks out at the world. It's a different world than the one they were promised, but it is one they are determined to navigate, armed with the truth of how we got here. By the early 2010s, something strange begins happening. The economy is technically recovering, stock markets climb again, corporate profits return, GDP expands. Headlines announce progress, yet millions of young adults feel almost none of it. On paper, the machine is working. In reality, many participants inside the machine feel stuck. And this creates one of the most important contradictions in modern economics. An economy can recover statistically, while large groups remain financially wounded. Numbers improve, people do not, because averages conceal structure. Imagine 10 people standing in a room, 9 lose $10, 1 gains $1,000. The average income of the room rises dramatically, but most individuals become poorer. Aggregate data sometimes behaves similarly. Growth can exist without broad distribution. This reveals something fundamental about modern finance. The issue is not simply earnings, the issue is ownership. Throughout history, labor income and wealth accumulation move together. People work, they save, they buy appreciating assets like homes. But increasingly, wealth generation becomes concentrated around asset ownership itself. And millennials enter adulthood at exactly the wrong moment. Let's draw another mechanism. Start with a central box labeled central banks. After the crisis, they lower interest rates dramatically. Lower rates make borrowing cheaper. Cheaper borrowing encourages spending and investment. Businesses hire, consumers buy. That is the theory. Now draw arrows outward. Money becomes cheaper. Investors seek returns. Capital flows towards stocks, real estate, and financial assets. Asset prices rise. People who already own assets become wealthier. People who do not watch prices move further away. If homes become more expensive while wages rise modestly, entry becomes harder. The ladder moves upward while people are still climbing. Research documents widening wealth disparities across generations. For previous generations, housing was a bridge. For millennials, it's a locked gate. The old equation changes. Work no longer guarantees ownership. Ownership increasingly determines outcomes. Housing becomes the perfect example. By the 2010s, housing prices in cities begin significantly outpacing income growth. When the monthly burden rises, down payments become larger. Some say millennials should simply move somewhere cheaper, but jobs are not distributed evenly. Economic opportunity clusters geographically. The trade-off is difficult. Move toward opportunity and face high costs. Move toward lower costs and sacrifice earnings potential. Then another force enters: technology. The platform economy presents flexibility as liberation. Drive when you want, work when you want. But flexibility and stability are not identical. Gig work often removes health benefits, retirement contributions, and predictable schedules. The paradox appears. A system marketed as increasing freedom sometimes transfers risk downward. Companies reduce costs, workers absorb uncertainty. Notice the pattern: student debt, housing, labor markets. Risk slowly migrates from institutions toward individuals. Retirement is another example. Pensions shift toward defined contributions. Now individuals must act like portfolio managers without financial education. Then arrives the 2020 pandemic. Cities slow, offices empty, businesses close, entire sectors freeze. Asset prices surge afterward. Stocks recover, housing accelerates. Those with investments benefit, those without remain behind. Generation Z begins asking uncomfortable questions about affordability and debt. The millennial experience becomes a blueprint for the present. Financial innovations arrive with promises. But where does risk actually go? Risk rarely disappears, it usually relocates. Ask 3 questions. Who benefits normally? Who absorbs losses when things fail? What assumptions must remain true? Systems appear stable until assumptions stop cooperating. Think of 2008, or the assumption that housing prices cannot fall. The millennial story is not about avocado toast. It's about structural analysis. Understanding systems creates agency. Context matters. Imagine 2 runners, one on flat ground, one running uphill carrying weight. The track determines the outcome. The invisible gears of education, debt, and housing turn beneath outcomes. Modern finance shapes when we marry and where we live. Once you can see the structure, you stop confusing symptoms for causes. You stop accepting simple narratives. The future belongs to the people who understand the machinery. Start asking better questions. See the architecture for what it is.